For every $1 of investor money they manage, some of the biggest hedge funds in the world control around $13 of market positions. That is not a rumor. It comes from data the funds themselves file with United States regulators. This army of borrowed money is run by a specific kind of firm, the multi-manager platform, better known as a pod shop. On a calm day, you never hear about them. But when a crowded trade turns, that leverage can flip from a quiet engine into an amplifier that shakes the whole market. Let's open up the machine. Why should you care about a few private funds? Because of their size and how they are wired together. The multi-strategy segment now runs a record of around $428 billion of investor capital. The biggest names are household names on Wall Street. Millennium at over $90 billion, Citadel near 6 to 7.72 around 42, Balyasny 37. Layer their borrowing on top, and their real market footprint is several times larger, and nearly all of them borrow from the same handful of prime brokers. So when one flinches, the tremor travels through shared plumbing to everyone else. The Bank of England has warned in plain terms that these funds can amplify market moves when they pull back. Let's define YAML. A pod shop is not one trader with one big view. It is a platform of dozens or hundreds of small teams called pods, each running its own book, each on a tight leash. If a pod loses a set amount, usually a small percentage, its risk is cut automatically. The platform stays close to market neutral overall and squeezes many tiny, uncorrelated bets for steady returns. To turn small edges into big returns, it uses a lot of leverage. And that leverage has climbed. Regulatory data show gross leverage for multi-strategy funds rising from around 4 times capital a decade ago to 5 to 7 times before 2021 to roughly 13 times now. More leverage means more return in calm markets and a shorter fuse in bad ones. So what lights that fuse? Here is the machine that turns leverage into contagion. Start with a crowded trade, many pods across many firms, quietly holding the same popular positions because they use similar data and similar models. Step 1. That trade slips against them. Step 2. Because they are so leveraged, a small price move becomes a big loss relative to a pod's tight risk limit. Step 3. The platform's rules kick in automatically. Cut the position, reduce risk now. This is called degrossing. Selling the longs and buying back the shorts to shrink exposure fast. Step 4. But everyone is crowded into the same names, so they are all forced to sell the same things at the same time. That selling pushes prices further against the trade, which trips the next pod's limit and the next. The very leverage that smoothed returns now pours fuel on the move. Nobody has to panic. The rules do the panicking for them. This is not a thought experiment. In August 2007, a sudden unwind of crowded quant trades hit these strategies so hard that a typical leveraged version of the trade lost roughly a third of its value in 2 days, then snapped back on the third, punishing anyone forced to sell at the bottom. It happened again, faster, in 2025. After the April tariff shock, hedge funds recorded their largest one-day sale of stocks in Goldman Sachs's prime brokerage records, slashing exposure in days. Then, when the tariffs were paused on April 9th, the market rebounded almost 9.5% in a single session, and the most shorted stocks jumped about 12.5%. A violent squeeze on the very positions that had just been dumped. Up or down, the amplifier works in both directions. So here is the lens to keep. Multi-manager platforms are engineered for calm, many small, uncorrelated bets, tightly risk-managed, quietly compounding. But that same design has a hidden setting. Pile enough leverage onto enough crowded positions, wire everyone to the same prime brokers and the same risk rules, and a small shock can force synchronized selling that feeds on itself. In normal times, their correlations sit near zero. In a stress, those correlations can rush toward 1 and diversification vanishes exactly when you need it. This does not tell you when the next unwind comes, but when you hear that hedge funds are degrossing, you will know what it means. The amplifier just switched on. This channel explains how markets work. It is educational, not financial advice.